Moving along, welcome to your next lesson and arguably the most important lesson in this module. Buying versus selling or shorting. How to make money both ways in the stock market, okay? How to make money predicting that a stock is going to go up in value, and how to make money predicting that a stock is going to go down in value, short selling. And I'm going to explain it to you in the most simplest way possible, because learning how to short sell is very confusing at first. Some people have a hard time figuring it out, and the way I'm going to explain it should give you the basis of it, okay? But let's go into buying first. So buying to open, all right? Buying a stock when you're taking a position in the stock market is called buying to open. This is when you buy a stock. Buying to open a position in the stock market, expecting the stock to raise in value. If the stock raises in value, you would sell to close your position and keep the difference in the bought share price versus the sold share price. If the stock loses value, you sell to close and lose the value difference. Both trade profit and losses are always based on share size, your position size. Example, 100 shares at $1 is $100, right? If it goes down to 50 cents, you have $50. Goes to $1.50, you have $150, all right? Basic Barney math. All right, here's where it gets interesting. Yes, you can make money as the value of a stock decreases. So stocks are getting hammered right now. People are making money. People are making a lot of money short selling. Now, you could trade both ways in the market, giving you unlimited trade ideas every day and profit potential. Every day, the market is giving you an opportunity to make money. That's why people day trade. That's why I day trade. However, this comes with risk. Short selling stocks is risky, and we're going to get into why. You borrow shares from your broker, or I'm going to explain this better in the next slide, but think about this. You borrow shares from your broker to open a position. You sell them into the market, so somebody buys them off of you after you borrow them. You do this in anticipation that the market loses value. When this happens, you buy them back at a lower price. It's called covering your position, and your profit is the difference. Now, this can be very confusing, so I'm going to break it down a way that most people might understand, okay? Everybody's got a phone. You might not have an iPhone, but you have a phone, all right? So you got a friend, right? And you borrow an iPhone you don't have for free off of your friend. Now, keyword borrow, he expects it back, all right? So you sell it to somebody. You sell this iPhone to somebody for $1,000, all right? So now you got $1,000 in your pocket, but no iPhone. And you need to give the iPhone back to your friend, right? So you need to replace the iPhone you borrowed from a friend so he can have it back. Remember, you borrowed it. Now, you buy the same iPhone back from a marketplace, a store, wherever. But in the case of the 2 weeks you've borrowed this iPhone, a new iPhone come out. So that iPhone model you have decreased in value, okay? So you're able to buy this iPhone new, the old one, for $500. So you give $500 out of the $1,000 you had to the person, and you got the iPhone now. You give the iPhone back to your friend, and you keep the $500 difference from selling the first phone, right? So you made $1,000 from selling it, then you paid $500 to buy it back, and you made $500. That's short selling, okay? Hopefully you're able to understand that when I put it that way, all right? It's just you're borrowing shares off the broker, selling them, taking the profit, but to close your position, you have to buy them back in hopes to buy them at a lower price. But here's where it gets risky, because you can buy them back at a higher price, and there is unlimited loss potential. Why? Stocks can only go to zero, right? Company goes bankrupt, stocks go to zero. So if you bought a share of a $5 stock, right? You spent $5, bought one share, stock goes to zero, you lose $5, okay? But let's say you shorted that stock, right? Expecting it to decrease in value. The stock then goes to $100, okay? Stocks have unlimited upside, but very limited downside. So that $5 that $5 stock that you shorted all of a sudden goes up to $100. You just lost $95 if you didn't close out that position, okay? Because you got to buy that stock back at $100 to close that position, all right? So let's say, with the iPhone situation, you sell that iPhone for $1,000. You got $1,000 in your pocket now, but all of a sudden iPhone's going to shortage, okay? And every iPhone on the market now is worth $2,000, and you got to buy that phone back to give back to your buddy. So you just lost double what you paid, all right? And that's why shorting stocks is a very risky thing, but That's why I'm here. In this course, you will learn to never find yourself in an unlimited risk position. You will never experience a loss like that if you follow the risk management I'm going to teach you in this course. Obviously, I can't make trades for you and practice money management for you, but I will give you the tools so that you will not have unlimited risk in the stock market when short selling stocks. All right, this is a very important lesson. I hope you guys found value in it, and I will see you on the next one.